Okay, so reading 12. Okay, the last reading for FSA, and very easy one also. So here, self-reading kind of topic only, this one. Integration of financial statement analysis techniques. So here, this one we should read. See, the primary purpose, just go through this one, very basic stuff only. See, this financial statement analysis techniques, you will find level 1 stuff, that is DuPont analysis, where you will analyze and break down ROE, those kind of thing you will find. Okay. So basically we are analyzing the financial statements, right? Okay. And why are we doing it? To know about equity ownership, interest, lending decisions, evaluating credit ratings. So all these are the reasons. The framework can be used in making decisions about all these things. Framework for analysis. So basically here, they have given an example of return on equity. Like for return on equity, if you want to analyze, how will you analyze? So you will analyze using this 5-way DuPont analysis, 3-way DuPont analysis. You remember this formula?
Yes.
Return on equity is equal to your tax burden ratio, interest burden ratio, EBIT margin, total asset turnover, and financial leverage. So similarly, for each objective, there will be a framework how it has to be done. So they cannot now explain each and every framework, but they have given one example. So that one example here, is, see here, this is the framework, and here they have given one example. What is that example? Yeah, that example is given over here as return on equity. Okay, see, first of all, establish the objectives. So perspective of the analyst, that is evaluating your debt equity. So what is your intention? Do you want to analyze debt equity ratio, or do you want to analyze return on equities? Do you want to analyze capex investments? So what do you want to analyze? Need or concerns communicated by the client or supervisor, institutional guidelines. So this will set the base, like what do you want to do. Okay, then output, purpose statement, specific questions to be answered. Then so specific purpose is what? Say for example, debt to equity ratio. So in debt to equity ratio, do you really think the company is in trouble because of debt to equity ratio, or they might be in trouble because of debt to equity ratio? So you want to check all those. That is the purpose. Specific questions to be answered is, are they earning enough? Their EBIT, this interest coverage ratio, whether their interest coverage ratio is good enough, that is interest divided by EBIT, right? So are they earning that much or not? Nature and content of the final report, timetable and resource budget. So this is similarly, each uh, topic will have a purpose. Similarly for return on equity, similarly for capital expenditure, so similarly for sales, so like this, or asset turnovers. So like this, various objectives you can set. Then what will you do after that? Based on the objectives, you will collect the data. Where will you collect the data from? Financial statements, then from suppliers, customers, competitors, management. You will get data from these people. Then the output will be what? Organizational financial information. That means you will organize financial informations. That means financial statements you will get. Okay. Then process data. So with that data, you are going to process it. Data from step 2. Adjust financial statement, common size statements, ratios, forecast. Adjust financial statement, common size statements, ratios, forecast. Adjust means what? Now whatever they are giving, you are not going to blindly take all those things. You will take and then you will adjust it as per your requirement, because there is a difference between the intention of the analyst and the intention of the company. Company is giving you all the format to you, like for example income statement. In the income statement format, they will give you they will give you, let's say, they will give you uh, income statements. Okay, they will give you income statements. Then they will give you balance sheet. Okay, they are giving you, let's say, cash flow statements. Beyond that, you have to scrutinize, you have to analyze, and you have to go into the depth of all those. So you will have to adjust various things over there. Okay, so that is adjusted financial statements, common size statements, then ratios and forecast. So many other things out of these statements, that is income statements, then cash flow statements, and balance sheet, we have to produce various other ratios which the company might not have provided to us. Okay, and then forecast, analyze data, so data from steps 2 and 3, then results. Okay, then develop and communicate conclusions. So results from analysis, published report guidelines, results from analysis. Okay. Develop and communicate conclusions. Results from analysis, published report guidelines. Output will be report answering questions posed in step 1. So whether you are comfortable with the debt to equity ratio or not. What is the recommendation? Then follow up periodically. You are able to understand this one?
Yeah, yeah.
Okay, so when you go into in-depth, in-depth analysis like this, each and every subtopics you will have to check. For example, debt to equity ratio, return on equities, or uh, uh, yeah, as I said, like or related to equities, how much they are raising capital, okay, or capital expenditure. See this they have given some examples. See, of course, which data are processed and analyzed will depend on the specific objectives of the analysis. In the example we present here, the objective is an analysis of a purchase decisions for a long-term equity investment. The analysis focuses on the following. Okay, the objective is an analysis of your purchase decisions for your long-term equity investments. So how are they, what are they purchasing? Okay, the analysis focuses on source of earnings and return on equities, asset base, capital expenditure, capital allocation of decisions, earnings quality and cash flow analysis, market value decomposition. Okay, yeah, market value decomposition. Okay, then anticipating changes in accounting standards. The analysis focuses on the following. In the example we present here, the objective is an analysis of purchase decision for an equity. A detailed example financial statement adjustments and analysis is the best way to address the LOS in this topic review. To make the example easier to follow, we provide the financial statement data necessary to conduct our analysis as needed rather than all at once. To make the example easier to follow, we provide the financial statement data necessary to conduct as needed rather than all at once. So they have given few data, necessary data only they have given. So that comes over here. We consider the acquisition of minority interest in Thunderbird Corporation, a publicly held company located in US. Thunderbird is a leading producer of electronics components used in automotive, aircraft, and marine applications. Sources of earnings and return on equity. Okay, so here sources of earning is this one. So basically, the intention here is the objective of an analysis of purchase decisions. So so when they are purchasing, whatever they are purchasing, whether that is all these are related to purchase. So here, all these are related to purchase. So first of all, they are calculating like how are they earning money? That means return on equity. So for return on equity, this is the analysis for return on equity. Okay. Now this do point decomposition allows us to identify this paragraph. You read it. I'll just write down the points here. It will be easier to understand and see. We are with the objective of purchase decision. Purchase decision. Okay. So analysis of purchase decision for your long-term equity investments. Okay. For a long-term equity investment. So number one, sources of earnings. Okay, so in this one, return on equity. Okay, that is the source of earnings. So this is used to identify performance drivers. So this will help to identify performance drivers. That means whether it is because of tax burden or interest burden or EBIT margin, tax, asset turnover or financial leverage. What is helping for the return on equity? Okay. Performance drivers. Then as mentioned before, the equity method is used to account for influential investments. Yeah. Under the equity method, the investor recognizes a pro rata shares. Okay. These are all equity method information. This is just like a recap. Under the equity method, the firm's investments under the equity method, the firm's investment is reported as a balance sheet asset. Total asset should be reduced by the carrying value of investments. This will increase asset turnover. We can use the extended DuPont equation to determine the overall effect. Have you understood this part? Why they have added all this? Because in a company, now there is balance sheet. In the balance sheet, there is, they are using investments associates, right? Investments in associates. You remember this one for
Yeah,
equity method?
yeah.
So because of this investments in associates plus what is the next one? Proportional profit.
And then
And then
depreciation.
minus depreciation. And then again minus dividend.
Dividend.
Okay. And in the cash, dividend will be added, that dividend. So now this part is all coming from other investments, which is increasing the asset. So what should we do? So we can adjust. These are all the adjustments an analyst will do. Adjust means what? The analyst will remove this. Okay, reduce the carrying value of these investments. So when he reduces, it will increase asset turnover, total asset turnover. Why? Because the formula is what? The formula is revenue by assets. No? So revenue by asset. So now asset will come down. When asset is going down, overall the performance asset turnover will go up.
Okay, yeah.
Okay, so here, so this is one example they are giving you, like what sort of adjustments we will have to do. Okay. In order to make accounting equation balance, you might be tempted to adjust equity downward for the elimination of the investment asset. However, without information about how the investment is financed, equities or stock, cash or combination, it would be arbitrary to adjust assets and equities for purpose of calculating leverage. Unless the question specifically provides this information, don't adjust the leverage. You are implicitly assuming that the investments was financed using the same leverage as the rest of the company. Okay. So these are all further nuisance. So we need to have these details also, whether it was financed through debt, stock, or cash. Because when we were doing the sum, we assumed that it was all financed by cash. So that's why you remember we will reduce cash and then we will increase this investments in associates. Hello?
Yeah, yes,
Yeah,
yes.
yeah. Okay. But actually, it need not be right. It may go for just 1 minute.
Yeah.
Hello?
Yeah, yes.
Okay, this is fine. Then similarly, now using this data, we can decompose Thunderbird's ROE using the extended dew point equation. These are all some numbers given. So directly they have given the numbers. Okay. So these are the numbers. So financial data, income statement, revenue, EBIT, EBT, income from associates and joint ventures, net income. Okay. Balance sheet, total assets, equity method investments, stockholders equity. Okay. Using this data, we can decompose Thunderbird's ROE using the extended dew point equation. See this return on equity, 19.521 here. And this is what is contributing. If you see, the leverage is more or less same only. Leverage is same. Tax burden ratio. So they are getting little bit of tax
Tax and interest
benefit.
are
Interest is also, yeah, little bit benefit. Then EBIT margin is more or less same. Asset turnover is also more or less same.
so they are paying more interest, right? Like in 2021, they were paying only 87%.
No.
It's
Now they are paying less interest. How?
mm,
Because see,
earlier they
interest
were paying
burden.
13%. It was like that, right? Earlier they were
Now
paying
they are
13,
paying
then
11
now.
percentage.
Yeah,
So it is less. Na? See, you can check here also. You can cross check. Say, for example, 2021, we will see. 2021. So interest should be the difference between these two. EBIT minus interest only we will get earning before tax, right? So how much is the difference coming? 10517 minus
yeah. Yes.
9463.
1206.
Yeah. So the formula for interest burden ratio is
Interest upon EBIT.
interest by EBT by EBIT, no? In EBT by EBIT, okay. Achha, then okay, EBIT. So we can directly calculate. EBT is 9463 divided by EBIT 10517. How much?
Yeah.
Into 100 you may take for taking percentage.
It's 105. 89.9%.
89, no? This one.
Yeah, 89.9.
That is for 2023. Okay. Similarly, if you want to check for 2021, so you take 7258 divided by 8313.
It's 87.3%.
Okay. Decreased, right? Interest charges and tax they have decreased. Then you can read this one.
Okay, sir.
Are you able to understand all this?
Yeah, so they have removed the unusual item. What does this mean?
Huh. 1 minute. Another common adjustments made by analysts is to remove the effects of any unusual items. Example, see this one. Provision for restructuring, litigation, goodwill impairment. See, these are not going to be repeated again and again. So as an
Removing that is
analyst, and
better.
as an analyst, you want to focus on only those transactions which are going to recur. So that will give you more certainty about the income.
Yeah. Just this line also, like they are saying, if we remove equity income and equity investments, so we can examine that on standalone
हाँ
basis.
हाँ हाँ
You can explain this one also.
हाँ. This one, right? You said this one.
No, that point only. This by removing the equity income of equal first line.
Okay. By removing the equity income of Eagle from earnings and equity investments from total assets, we can examine Thunderbird's performance on a standalone uh, uh, basis. Okay. So Thunderbird. Okay. We consider the acquisition of a minority equity interest in Thunderbird Corporation. So Thunderbird is a subsidiary kind of, not subsidiary, but yet kind of target company, right? Where we have invested. Eagle is the company which is investing.
Yeah.
Okay. Eagle is the one which is invested. Okay. So by removing the equity income of Eagle from the earnings and equity investments from total assets, we can examine Thunderbird's performance on a standalone basis. Yeah. So that means when we calculate for Eagle, so we are calculating all for Eagle now here. Now, how do we calculate? We will bring in net profit here, plus we will take proportional profit. Okay. Then minus depreciation. Then we will get the adjusted profit. So by removing equity income of Eagle from earnings and equity investments from total assets. So if you remove all this, you will get the income earned from this income earned from Thunderbird. Okay.
Yeah.
Plus balance sheet perspective, investments in associates. Here you will take proportional profit minus depreciation
Yes.
minus cash dividend.
Minus.
So from the total assets, see here it says by removing equity income of Eagle from earnings. So this is the total earnings.
Equity investment
Okay.
from total assets.
And equity investments. Another common adjustment is to remove by removing the equity investments from total assets. So from this total assets, you can remove and you can analyze this separately about how it is doing. Okay, and also you have to remove this part as well, or you have to adjust this part as well.
So, like I'm thinking, if we are removing all the equity, that will remain, like that income that we are.
That will remain means which one you are talking about?
Just
See, we are removing. See, we are removing. We are see. Imagine we want to study now Thunderbird company.
Yeah.
So how do we study? We have to remove this part, and you have to remove this part.
Okay.
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 Understood. Yeah.
Okay. You may read this part as well. We did not adjust the financial leverage because we assume the investment in associate use the same capital structure as the parent company. Okay. This also. Then next is asset base and capital structure. So asset base and capital structure is here. Next, asset base and capital structure. Okay. So here, analysis of the asset base requires an examination of changes in the composition of balance sheet assets over time. Presenting balance sheet items in a common size format. Common size presentation of Thunderbird's assets. Okay, these are all given condition. So now what do we find out over here? Current asset was 40.7% before, now 34, now 31. So current asset is coming down. Property, plant and equipment is more or less same. Then identifiable intangibles is increasing. Okay, identifiable intangible is increasing. Goodwill is also increasing. Okay, other non-current assets is also increasing. So based on this, we can say yeah, goodwill has increased, indicating Thunderbird has completed a number of business acquisitions, right? Okay. So goodwill is increasing 26, 28, 29. That means they are acquiring, okay, businesses. Okay. You understood this one? This point is okay?
Yeah, yes.
Okay. Then increase in Thunderbird's EBIT margin and return on equity may be partially due to successful acquisitions. However, since goodwill is no longer amortized through the income statement, we must consider the possibility of losses in the future if goodwill is determined to be impaired. So these are all the hidden things which no company is going to directly tell you, which you have to understand all these things.
Yeah.
Right? So these are the analysis. Then next is capital structure. So in capital structure, uh, financial leverage ratio. So this thing, yeah. Where is it gone? Yeah, capital structure. Thunderbird's financial leverage ratio has decreased over the last 3 years. So is it decreasing? Financial leverage 12.3 they said, right? Financial leverage, it is slightly decreasing. Okay. Unfortunately, the ratio does not reveal the true nature of the leverage, as some liabilities are more burdensome than others. That is also possible. Okay. Then see, now based on this this information, we can see that long-term debt has decreased. So 12, 10, 8. So clearly it is decreasing. So this is all about studying the analyzing. You will not get questions all this like this in the exam, but it is a good one to understand. Practically, you will require to do, if you should do all these things to completely analyze your company. So what is financial modeling? This is only where we put all these things in an Excel sheet and it becomes financial modeling then. Okay. And we make it like a record. Okay. So here purchase is equal to cost of goods sold plus change in inventory. Okay. Revenue, cost of goods sold, purchase. That purchase has been elaborated here. Okay. Then next is capital allocation. Now capital allocation, consolidated financial statements can hide the individual characteristics of dissimilar subsidiaries. As a result, firms are required to disaggregate financial information by segments to assist users. Okay, firms are required to disaggregate because they are buying many companies, right? So um, because all companies are having dissimilar subsidiaries, then it becomes very difficult actually. So segment wise, company firms are required to provide information to disaggregate financial informations. Okay, so here recall that a business segment is a portion of a large company that accounts for more than 10% of the company's revenue. So if anything is, any business segment is contributing more than 10%, then it should be distinguished. That is the rule then. If it is less than that, then they need not. Then similarly, this is the revenue and EBIT. So revenue, see different segment: aircraft, automotive, marine, specialty. These are the revenue. So we can see here from 2021, this segment is growing, aircraft. This is not growing. See, automotive from 47, 47, 46. Then marine is decreasing. Then this is 9.6, 9.8, 9.7, more or less same. Similarly, EBIT is increasing. See, so aircraft is also increasing. EBIT is also increasing. Revenue from aircraft is increasing. The EBIT from aircraft is increasing. So like this segment wise also we need to study. So there are so many details when we want to analyze a company. Okay. Then here asset and expenditure wise, 12, 15 and 27. See, very high jump. Investments in assets, a very high jump. Okay. So here automotive division requires the greatest proportion of assets and capital expenditure. So greatest proportion of assets and expenditures. Okay. Automotive, right? So that is over here. See, 37%, 37.4. Assets and capital expenditure also 42.3. That is the reason. Understood this one? So out of all the expenditures, capital expenditures, maximum money is going towards automotive. Okay. And it was not doing very well, right? Automotive sales was also coming down. I think 47
Only
to
aircraft
46.
is
Aircraft is doing well, but aircraft capital expenditure is not like increasing. Okay, yeah. Then this paragraph you can read.
yeah.
A ratio greater than 1 indicates that the firm is growing the segment by allocating greater percentage of its capital expenditure to a segment than that segment's proportion of total assets. Conversely, a ratio of less than 1 indicates the firm is allocating smaller percentage of its capital expenditure to a segment than its proportion of total assets. If these trends continue, the segment will represent a more or less significant proportion of the firm over time. Okay. Here, this line, have you understood? Not equal to total assets due to, because it will not be equal to total assets, because apart from this, they must be investing in all others. Just add up all this. Like here, this is assets and this is capital expenditures. Yeah, not equal to total assets. Yeah, so it will not be matching with the total assets. Where is the total assets, current assets, then current liabilities? It need not be matching, but because it is not giving us all like totally, only certain excerpts has been given here, no? So total assets here 8261. It is not going to match. That doesn't matter. Yeah, because only certain information has been given, not the entire balance sheet. Okay. Specialty products divisions has by far the lowest EBIT margin. Yeah, so this is the lowest one, EBIT margin perspective. So it is just you are analyzing segment wise companies. You can read all this also. Cash generation and EBIT margins. This is EBIT margin 22-23. Cash flow to average assets. Okay, 22-23. Average assets are calculated as beginning assets plus ending asset divided by 2. Using the data from 12.9, the 2023 average assets for the aircraft division is, so this is the average. Okay, hence for 2023, the cash flow to average assets for the aircraft division is this much. So I hope all these are fine for you, right? It confirms poor capital expenditure, poor capital allocation decision to the specialty products. Okay. Figure 12.13 confirms. So cash flow and EBIT margin. So this is the, okay, you have spent 13.6 percentage of cash flow to assets. Poor capital allocation decision to the specialty. Okay, and it is given only EBIT margin of 7 point. It is decreasing.
Yeah.
Rest all are stagnant. Okay. While continuing to produce superior operating margin has fallen behind. Okay, this is about aircraft. So aircraft is giving better margin. Okay. The next is earning quality and cash flow analysis. This is again common thing only. You can quickly read all this. Even this also. This is self-reading one only. Now accruals ratio point of view. Accruals ratio, see, here the key word is from here operating assets. Balance sheet approach. Using the balance sheet, we can measure accruals as the change in net operating assets over a period. Accrual as the change in net operating assets over a period. Net operating assets is the difference between operating assets and operating liabilities. Operating assets are equal to total assets minus cash equivalent to cash and marketable securities. Why can you understand like this? Why they have mentioned? Because see, uh, in the balance sheet, you have fixed assets, then current assets. In this current assets, you have cash as well. So operating assets are equal to total assets minus cash and cash equivalent and marketable securities also. So marketable securities as well. Marketable securities. So out of all this, see, you are basically employing all these things in your business, except this cash and marketable securities, because it is there with you. Rest all you have invested. This cash is in the form of cash only with you. Rest all are what? You used cash to buy all these things for your business. So rest all are for your business. This cash is just there. Okay. So operating assets are equal to total assets from there minus cash equivalents, marketable securities. Similarly, operating liabilities are equal to total liabilities minus total debt, both short term and long term. Okay, because this money is with you, cash is with you, this one. Rest all you have utilized it for the business. In summary, the formula for balance sheet based aggregate accrual is equal to net operating assets ending value minus net operating assets beginning value. So you have to, this is an important paragraph. You have to spend some time understanding these formulas. Okay, so should I write it here, because they have given like a theory. So we have, if we make it like a formula, then it will become easier. So net operating asset is equal to operating assets and operating liabilities. Okay, operating assets and operating liabilities. Operating assets are equal to, now operating assets are equal to total assets minus cash and cash equivalent marketable securities. Okay, then operating liabilities. Total liabilities minus total debt. Debt means short-term and long-term debt. And then the formula for balance sheet based aggregate accruals. So balance sheet based aggregate accruals. Balance sheet based. Net operating assets ending value minus net operating assets beginning value. Okay. In order to make comparison, it is necessary to scale the accrual measure for differences in size, just like return on assets and return on equity. So the measure can be distorted if your firm is growing or contracting quickly. Scaling the measure also allows for comparisons with other firms. Scaling is done by dividing accrual measure by the average net operating assets for the period. The result is known as accrual ratios. So this is accruals and now it is accrual ratio. Accrual ratio is, so that means on an average what it is and now what it is. Okay, so accruals ratio.
So, can you tell me what is the formula for accrual balance sheet? What you have written?
I have written this part only.
And what is this
Ending value.
of?
Ending, opening balance and ending balance
Of
for that particular
accruals.
time period. Accruals. You see, net operating assets.
Okay.
So net operating assets, how are you getting? This is the operating asset. This is the operating liabilities. So when you minus, you will get net. This one.
Okay.
Net operating assets ending and net operating assets beginning. Okay. And this is amount. So net operating assets ending. Okay. Minus net operating assets beginning divided by net operating assets ending plus net operating assets beginning divided by 2. So this is the average. Now why should we do like this? Because it will tell you what is the average amount. Say for example, the average amount is 1000 and here it is let's say the difference is 1000 and 1000 and like 1050. So now 1.05. So that means on an average, normally it is average is 1. So now we are increasing. Accruals are increasing. That means in this case, accruals are increasing. If this would have been something like 950 by 1000, then that means 0.95. So the accruals are decreasing. Yeah. Accrual ratio. Then similarly, this one, cash flow statement. Then cash flow statement. This one is okay. Net income minus CFO minus CFI. What does this mean now? See, accruals total from this income, net income. See, ideally, if we are assuming, this much amount we have got net income. Out of that, we have got this much only cash. Out of that, again, we have invested also some amount. So rest is all accrued one. For example, okay. So rest is all what? Otherwise, you can even say rest is all cash flow from, no, see. You have, let's say, see, we can derive the aggregate accruals by subtracting cash flow from operating and cash flow from investing from reported earnings. So accrual is equal to net income minus CFO minus CFI. If net income is 100 rupees, cash flow from operation is, let's say, 70 rupees, and cash flow from investments. So from this net income only, you are spending, you are left out with only 30 rupees now. Okay. Now from this 30 also, you have spent cash flow from investments, let's say 20 rupees. That means this 10 rupees, you don't have it now with you. Okay, the money is all spent over here. So this 10 rupees is what? This 10 rupees is the accrual. That means you are going to get this later. Okay. See why CFF is not mentioned. Okay, here they have given one good reasoning here. You might wonder why CFI and CFO appear in the cash flow statement approach to calculating accruals, but CFF does not. The purpose here is to calculate persistence and reliability of earnings by calculating accruals as a percentage of net income. Okay, higher accruals indicate less reliability. Correct? Because 10 rupees you did not get out of 100 rupees income. Now, similarly, if I say out of 100 rupees income, if you are not getting 20 rupees, that means what? That means more, you don't want more accrual here when you are earning. When you're earning, you want less accrual, right? Instead of, out of 120 being accrued, you want out of 100, 5 rupees being approved. If this is the base case, between this two, this is 1 and 2, which one you would prefer? You would prefer second one. From 10, you want the number to become 5. Okay. So this is also a good point.
Like we'll get 5 rupees.
So that means 95 is all cash. That cash is, is gone into, CFI. Yeah. Okay. This is a good point. So,
we can say accruals lower the better.
Lower the better, yeah. So this is a good point. Okay. So yeah, this is all you are able to understand. These are good points. Yeah. Okay. Hmm. Hmm. Yeah, so similarly, this is accruals ratio. Like the balance sheet accrual measure, the cash flow measure must be scaled for comparison purpose. So lower is better there when it comes to accrual. Okay. Then next is net operating assets. So this is total assets minus cash. You will get operating assets. Total liabilities minus short-term, long-term debt. You will get operating liabilities. Net operating assets. Then balance sheet accruals. So the balance sheet accrual is year to year change in net operating assets. Okay. So operating assets, operating liabilities. Operating assets, operating liabilities, net operating assets, and then year to year change in net operating assets. Okay. Just take this difference, 52,786 minus 44,673.
800,813.
That is this one.
Yeah.
So this is the accrual difference between net operating assets. Okay. Hmm. What is this 3 they mentioned? Where is it? Hmm. This is for 1. This is for 2. What is this 3 here?
Cash flow accruals last.
Acha, this one. Okay. Cash flow accruals. So 7967 cash flow accruals. This one and this one and this one. Okay. So they are mentioning like how you are getting 9587. Net income minus operating cash flow minus investing cash flows. Yeah. And here, balance sheet accrual 8113, we understood how we got it. Yeah. Then,
Average annual.
yeah, this
Like
one
average of
48 is the average. That average,
4.
how you know that average is uh,
Yeah, so I'm
this one,
getting this
this one. Yeah, 40.
48,729.
Yeah, 52,786 plus
44,673
44,673 divided by 2.
yeah, getting.
Okay. Then, yeah, so then it's okay. You will not get question. You should know the formula and then little bit of practice around how to get these numbers and all. That much is enough. Rest is all. More you do, obviously, you will get more conviction about the topic. So it is better only. Okay. But knowing the formula and applying is not that tough as such here. Just you should be clear with the formula. And couple of times if you practice it, it will be fine only. Okay, you may read all this now. Okay.
So like if the accrual are increasing greatly or decreasing widely, like so there is a earning manipulations.
Because your income is increasing, but cash is not increasing. Na? Accruals are increasing.
Okay.
Okay. Then this is suspicion, right? You have to analyze. It is not a great, increase in income, na? Where you are saying your salary is going up, but your take-home salary is not going up. Then what is the use that way? Okay. Then here you have to know this formula. Cash generated from operations can also be calculated as EBIT plus non-cash charges minus increase in working capital. This formula also you should know. Okay. Then here, cash generated from operations. So this is, you can divide these to 12,109 divided by 10,517. You will get 1.15.
Yeah, so
Okay. Yeah. So the ratio of CGO to operating income confirms that cash generated from operation has exceeded operating income. Yeah. Over the past 3 years. Okay. The results of this analysis reduce our earlier concerns of potential earning manipulation from our accrual analysis. The ratio of CGO to operating income confirms. So operating income perspective, cash is going up. Is it going up? Yeah. one, all are above 1, no? So here it is fine. Okay. Cash return on total assets has increased over the time, okay, which seem to justify the recent acquisitions. Okay. We need to calculate the cash flow to reinvestment, cash flow to total debt, and cash flow interest coverage ratios. Okay. CGO to capital expenditures, CGO to total debt, CGO to cash interest. Okay. All three cash flows presented in 12.8 are reassuring. How? Because your capital expenditures, for every 1 rupee capital expenditure, capital generated from operation is more, so which is good. From every 100 rupees debt, capital generated from operation is 21, 22, 23 is
increasing and decreasing.
yeah. And here, from here, this is also very good. This is very good because for the cash interest, over 1 rupee cash interest paid, we are getting 21 rupees
Extra.
cash generate, yeah, which is good. Okay. This indicates sufficient resources to fund Thunderbird's ongoing capital expenditure. So this is all fine. Is it over? Still there? Okay. Just little bit, yeah. Market value decomposition. Again, this is all self-explanatory only. Yeah, this you yourself can understand all this. See. Thunderbird owns 30% equity interest in Eagle Corporation, a publicly listed firm located in Europe. Let's suppose that the market capitalization of Thunderbird is 137, and also imagine that market capitalization of Eagle is 60 billion. Okay. So Thunderbird owns 30% equity interest in Eagle Corporation. Okay, and market capitalization of Thunderbird is 170. I'll just write down all these points. %30 equity. Market capitalization of Thunderbird is market capitalization $137 billion, and Eagle market capitalization. $60 billion at year end. Exchange rate is $1 is equal to 1 euro is equal to $1.40. This is the case. In this case, Thunderbird's pro rata share of Eagle's market value is 25.2 billion. Okay, so they have converted all into dollars. So this is 60 billion euro. This is euro. So if I convert this 60 billion euro, so it will be multiply these two, cross multiply 60 into 1.40.
84.
84. Out of that, 30 percentage. Take 30 percentage of this.
25.2.
This is the share, 25.2. So from this 137, 25.2 belongs to Eagle. Okay, so 137 minus 25.2, that is 81% of Thunderbird's market capitalization. Is it okay? Because if you minus this 2, you will get 111.8. Just check.
Yeah.
Okay. So that means out of its total capitalization, 81.6 belongs to Thunderbird and almost 20 is because of Eagle Corporation. Similarly, now we have to calculate for P ratio. So P multiple without Eagle. Let's suppose Thunderbird's P multiple is 17.1 and it's this is market capitalization to earnings. Assuming S&P 500 multiple is 20. Thunderbird's P is 15% discount. How 15% discount? Because right now it is 17.1 and industries is 20.1. So you can take the difference. Difference is how much? 3, right? 3 divided by 17.1 into 100. Just how much? Check.
17.54%.
How much?
17.54.
17.54. It says 15% discount. S&P is 20.1. 20.1 and 17.1. Acha, is it okay? Is it 3 divided by 20.1 into 100? You do in comparison to the
14.92. It means 15.
Yeah, based on the industry, 15% discount. Then the implied P multiple of Thunderbird without Eagle is P multiple comes to 15.7. So now 15.7 point of view, what is the difference? 15.7 minus 20.1.
What? 4.4.
Now you check.
21.8.
22% discount. Okay. Understood this one? this is the takeaway point. This is a summary. Yeah, so this is one concern. They were over allocating to lowest margin segment. What was that? Specialty products.
Yeah.
And then more, impairment may happen in future, so that may bring down the profits.
Yeah. So we are saying more impairment will happen because they are acquiring more.
Yes. So there will be more goodwill, so more impairment will happen. Fine, okay.
Yes, sir.
That's it. Now this subject itself is over. So what you do is you just go through all and come up with your doubts next time.
Okay.
Okay. Fine. We'll stop now here.
Yeah.
Okay. Bye.